morning, everyone. Thank you for joining today's webinar, Countdown to VAT in Oman. My name is Rami Ryan. I head the pre-sales and consulting activities for Thomson Reuters in the MENA region, and I'll be your host for today. Before we begin, I'd like to cover a few housekeeping items. For the best viewing experience, we recommend using a wired internet connection and closing any programs or browser sessions running in the background. The webinar is audio streamed through your audio on your computer or your mobile device, so please ensure the volume is turned up for the best audio experience. You can expand your slide area or maximize it to full screen by clicking on the arrows in the top right corner. Throughout the presentation, you can submit your questions through the Q&A section under the media player. We will try our best to address all questions, but if we run out of time, we will answer them offline. Your questions are not visible to the audience and will remain anonymous. Your feedback is really important to us, so please do fill out the survey and engage where you can. Thomson Reuters is committed to supporting you at this time, and we have uploaded resources available for download. We will have poll questions coming up during the webinar, and we would encourage you to participate to help us through the discussion. Now, please allow me to introduce our speakers for the event today. We have Thomas Van He, partner at Aurifer Middle East Tax Consultancy. We also have Dibka Rajan, Tax Director at Abu Tamam, Grant Thornton in Oman. We are also joined by Ganesh Nair, VAT Specialist, Grant Thornton, Saudi Arabia. And last but not least, Hilal Al-Rifai, our Senior Tax Analyst at Thomson Reuters. If you'd like to learn more about our speakers, please feel free to explore our speakers' bio section on the right hand of the screen. Once again, thank you, and really pleased to have all of you to join us today. So let me start by just setting the context a little bit on what's really happening in the GCC. And I would like to hand over to Thomas to just take us through what's really happening in the GCC and the tax landscape from a UAE perspective.
Thanks, Rami. Good morning to everyone. Thanks for the introduction as well. Assalamu alaikum to everyone joining in from Oman as well. The GCC has been through a number of reforms in the last few years, and it all kickstarted with the introduction of excise tax in 2017. The reforms in Oman right now, they're part of a broader pattern. Oman is the fourth country to implement VAT. VAT, as most of you will know, will be introduced in Oman on the 16th of April 2021, with the law having been published back in October. We're very keenly awaiting the executive regulations to be published. I think a lot of people are really eagerly waiting for that. I went back a bit digging into what happened in UAE and KSA in terms of the timelines for the publication. And let's say that Oman is not completely exceptional. So as you know, or as most people would know, UAE and KSA introduced VAT on the 1st of January 2018. Bahrain did so 1 year later on the 1st of January 2019. The KSA VAT law was published on the 29th of July 2017, so 5 months ahead. The UAE was roughly 1 month later in publishing its VAT law. So Oman actually was pretty foreseeing 6 months before the introduction of VAT to publish it. They were one of the first. In terms of the implementing regulations, in KSA, they were published around September, end of August, September in 2017. And the UAE, it was right before a long weekend at the end of November 2017, 1 month beforehand. As a comparison, Bahrain published its VAT law on the 10th of October 2018 and its executive regulations on the 19th of December 2018. So 12 days before the actual implementation. We are currently 3rd of March. That means that we have roughly around a month and a half. I think most people were expecting already the executive regulations to be published. But let's say Oman is keeping it interesting for now. Not to forget, in the broader scope of things, is Oman will be introducing personal income tax as well on high incomes as from 2022. This is a very important evolution for a lot of people in the Gulf. We do not know yet what the design of the tax will be. I'll caution already beforehand and mark my words, taxing high incomes is extremely difficult because the high earners, they have structures that they can implement. They have advisors that they can use in order to, countries that have tried to introduce a personal income tax on high incomes have very often failed. The second thing that I want to caution against as well is the potential consequence in terms of the expat population for Oman, which might reduce as a result of this. So that's an important evolution to be on the lookout for. Oman has been preparing for this as well by reforming its tax authority. Another thing that Oman did recently is it introduced country-by-country reporting. It is the fourth, so the next state will be Bahrain. The next state that will require filing is going to be Bahrain. So Bahrain already published it as well. And we also expect Oman to be introducing local TP documentation requirements, such as a local file and potentially, like Saudi and Qatar, an additional form as well. Before handing back, I think in the region, Saudi is by far the most active one, whether it is on changing the VAT law, which they have now done 4 times already since the introduction of VAT, and notably also with an increase of the VAT rate from 5% to 15%. It's quite a remarkable step that they have taken. Note also that the GCC VAT treaty only foresees in a rate of 5%, and that also the publication of this increased VAT rate is nowhere to be found. It is just the authority which has said, as from 1st of July, it's going to be 15%. And they keep on reforming as well zakat a few days ago, and corporate income tax as well a few months back. So bottom line is, I think it's interesting times for tax advisors, but it's also very important that everyone keeps following all of these evolutions, because a lot of them can impact your business without necessarily you having anticipated them. Back to you, Rami.
Thomas, thank you. Very interesting insights, especially on the income tax side of it and its impact on the expat population here. It's a bit taboo, I'd say, in my view, but let's see how this will impact other GCC countries. So now moving on to Ganesh. Ganesh, to the point that Thomas was mentioning, the changing VAT rates in Saudi and the regulations being changing over the course of time since the introduction of VAT. What's really happening in Saudi at the moment, and how are you dealing with those changes with your clients and the impact on how people are doing their business in Saudi? If you would shed some light on that, please.
Sure, Rami. Thank you so much, Thomas, for the quick update, and salam alaikum all. Hope I am audible. So before answering to the specific question, Rami, I would like to take a minute or so for a quick recap on the VAT journey so far in the Kingdom of Saudi Arabia. So as Thomas rightly mentioned, that Saudi Arabia implemented VAT in January 2018 with a standard rate of 5%. And the mandatory VAT registration threshold for business, as agreed in the GCC framework agreement, was $100,000. However, for small businesses whose turnover was below $266,000, General Authority of Zakat and Tax, who are the regulatory authority for handling the VAT in the kingdom, provided an additional 1 year for getting the business registered. So they got another year for VAT implementation that is like 1st January 2019 onwards. So basically, we have 3 types of VAT classification in KSA, that is standard rated. Earlier it was 5%, which would cover most of the goods and services. Then we have 0 rated, largely dealing into exports, international transportation, qualified medicines, and then qualified investment metals, so on and so forth. And then we have exempt from VAT for residential rent and certain financial transactions. The disadvantage for the exempt category there is that we cannot claim an input tax credit. unlike for standard rated and zero rated. So once the business gets VAT registered, Rami, the frequency to file the VAT returns are based on the annual revenue of the business. So if the revenue is more than US dollar 10.7 million, then the VAT returns needs to be filed on a monthly basis, and the due date is by the end of the month. And if it is less than 10.7 million US dollars, then the frequency is on quarterly basis. So with this brief background, I would now try and answer the question, Rami. So as we all know that the year 2020 brought unprecedented crisis due to the pandemic, and the Saudi government was the first among other countries to announce a set of support packages targeting the private sector, totaling around roughly 60 billion US dollars for easing the burden on business due to the pandemic. This stimulus actually included the payment of 60% of salaries to Saudi employees working in private sector for a period of 3 months. And we had this deferment of VAT paid through customs authority on upon the imports, so on and so forth. Note that the stimulus package was announced by the government in the backdrop of lower falling oil prices, reduced economic activity, and increased healthcare expenditure for COVID-19 for both residents and citizens. So therefore, in the month of May 2020, to be precise, on 10th of May 2020, government announced that it will seek to implement new fiscal measures to support the economy, and increased the VAT from 5% to 15%. It was tripled. The VAT rate was tripled with effect from 1st July 2020. We have a transition provision in place which would be like effective till 30th June 2021, which says that any contract being signed prior to 11th May for a period of 1 year, the business can continue with the 5% rate, but there are certain conditions to it. And Rami, quickly, if I can answer to your second part of the query, like whether is there any discussion on rolling back the VAT rate? I must say here that Ministry of Finance have made it very clear that there are no short or medium term plans to, in fact, reverse the hike, but might be looked into, that is the word used, in the longer term. So this 15% is here to stay at least for some time. So that's the KSA update from me, Rami.
Thank you, Ganesh. I've personally never seen a government that rolls back the tax rate, a hike that they've applied. Why would they give up that revenue? In my view, that's my personal experience. But yeah, so thank you, Ganesh, for that input. So Dipka, now moving on to Oman, and I mean, to Thomas's point and the points that he've highlighted, that the executive regulations not really being published so far, and the stress caused because of this current situation. What's really happening in Oman, and how are you dealing with your clients at the moment, given that the executive regulations are not published yet? How are people coping with that? How people are still preparing for VAT without the regulations? If you can shed some light on that, please.
Okay. Thanks, Rami, and thanks for the introduction. Good morning, all. Getting straight to the topic with Oman regulation, let's first understand that despite having direct taxation like corporate tax, municipality tax, tourism tax, why was VAT rolled out in the Sultanate of Oman? So despite having the initial rollout in the beginning of year 2022, it was even a shock to me and to all the people in the Sultanate. We didn't expect VAT to be rolled out in 2021. So it was definitely a need of the hour for the Sultanate. Where we started, we should understand where we started the year with a loss. That is the loss of our beloved Majesty Sultan Qaboos bin Said. Secondly, there was a reduced crude oil prices, which has actually dampened the economy. Thirdly, as Ganesh said, the global pandemic, the COVID, which has actually brought in economic crisis within the Sultanate of Oman. So that's the reason why our new leader, Sheikh Haitham bin Tariq Al Said, has introduced VAT in April 2021, which is exactly 6 months from the time when the VAT, the royal decree was issued. The VAT actually shall help the Oman government to infuse the funds into the economy, thereby increasing the GDP and support the fiscal commitments within the Sultanate. So that's one of the reasons why VAT was rolled out. Now, coming to your question, Rami, how can we help? We should understand, based on other GCC experience in other member states, a minimum gestation period of 4 to 6 weeks is required to actually implement VAT in any organization. So despite not having a VAT regulation, it's very important. We can do basic steps of implementing VAT. As we know, it takes 4 to 6 weeks. Let's look from the VAT registration point of view. As we know, the regulations are already out for VAT registration, which has come in Jan 2021. Now, registration has been planned in 4 phases, very similarly to the way it's there in the Bahrain market, where they had done registration on phase-wise. So very similarly, they are doing it even in Oman, which is time-bounded and segmented. If it's non-compliance, we should understand there's huge level, non-compliance will lead to penalties. Let me explain what are the 4 phases. The dates for each of the segments are: entities with taxable turnover over $1 million have to register before 15th of March 2021. Entities over $500,000 to less than $1 million have to register before 31st May 2021. The third entities between 250 to 500K have to register before 31st August, and the last segment being 38,500, which is $100,000 to 250,000, have to register before 28 Feb 2022. One of the questions which most of my clients are requesting is for group registration. Please note the VAT law based on Article 58 says that group registration is possible, but the executive regulation for the same is yet to be out. So we have yet to see on that. When it comes to returns, as we have seen Ganeshan saying that we are having returns monthly and quarterly in Saudi. In Oman, there is a provision for monthly return and for quarterly. So our first quarterly return would be from 16th April to 30th June, and our filing date would be on 30th July 2021. We still have to understand the regulation with regards to monthly return, which is not yet out. Again, now I'm sure everybody would be intrigued to know what are the VAT rates for Oman. The VAT rates in Oman, it's fixed at 5% in the year 2021. But we have to note that in GCC framework, there is a provision where there could be a revision on VAT rates from 3 years from the time when the GCC framework has been out. So yes, we could expect an increase in VAT rates in the year 2022 and 2023 going forward. Back to you, Rami. I hope I have replied to all your queries.
Thank you, Dubka. Thank you. It was very insightful, and at least it gives some sort of a roadmap on how companies or people should start preparing, or they are actually going through their preparation phase right now. But I mean, from my experience while I was dealing with clients in Oman, actually certain people are thinking, VAT is never going to come, and now it's coming. So I think now it's people really need to focus on how they prepare and be ready for the 16th of April, I suppose. So no, thank you for the insights. I think right now we'll have a few poll questions for the audience, and I would really encourage you to participate and just give in your answers. We'll give around 30 seconds for every question. It's good to make the session more interactive with your answers. Interesting answers, actually. So let's see. So thank you. All right, very interesting to see certain people saying VAT will not impact their business, but at the same time, people have budgeted something for VAT. It's good. I think I think the first question with the answers were that they've actually already engaged with their tax advisors is interesting. It's 50, I'd say half and half, 50% to 50%. It's good to have a team in place that are already aware with all the changes that will impact your business, because VAT really impacts your business in all different, in all aspects, whether on the procurement side or on the sales side. So good to see that. All right. Right. So, Thomas, if you allow me to ask you, since Dipka was mentioning that one of the ways to prepare for VAT in Oman, given that the regulations are not out yet, is to look at other countries, other GCC countries. So from a UAE perspective, can you just help us understand what would be, shed some light on certain mistakes and lessons learned from the UAE implementation, so it would be helpful for the audience?
Sure. So when I was preparing for this, I was trying to think, how did we do things in 2017 to prepare for 2018, and what's the status now? And I think we're hitting a point where UAE businesses and other businesses in the region as well have become a bit complacent. They think, some of the approaches from the finance teams is, it's like IFRS. We've implemented it, khalas, it's done. Someone is taking care of it. And I think it's a very dangerous approach to have. First of all, simply from the viewpoint of laws change, we've seen that in Saudi, we saw it last year in the UAE as well. A very, very important article in the UAE executive regulations has changed. And when we speak to clients and stuff, it's, sometimes I think they feel we're a bit annoying. We're trying to push our services, but generally we're saying this is really important to look at. The zero rate for services rendered from the UAE to abroad, it has been restricted. And I feel like when you say lessons learned, it implies that the UAE has learned a lesson and therefore can teach someone else a lesson. And I feel that that's not, entirely true. But let me nonetheless try a few. For KSA, I'll obviously leave it to Ganesh. My feeling is, in the UAE, 3 years down the line, we still have a significant amount of errors. And some businesses are putting their heads in the sand. There are a great deal of audits out there. There's a great deal of questions asked by the FTA, and there is a great deal of audits. And I think that's an important point to caution against as well for Oman. Oman has a bit of a reputation being, a bit of a slower jurisdiction. Everything is very, laid back. But the tax authority can indeed, they can wait as well, and they can come back to audit later. And I think that's a very important lesson, because you really need to get it right from the start. A lot of UAE businesses have hit very significant penalties. I've listed a number of things which are very basic matters, and where I think also Thomson Reuters with its technology can help a lot. Simply incorrect input VAT deduction. You get an invoice, the invoice is wrong, and you deduct it anyways. The FTA is simply going to reject that. Your own invoices, issuing incorrect invoices. It's strange for us to see that more than 3 years down the line, having had the time to look after things, to audit things, to look with your customers, with your vendors, that simply the format of the invoice is still wrong. It's strange to see. Filing incorrect returns, date of supply wrong place of supply, incorrect reporting of import value. This is a recurring thing in the GCC, unfortunately, a too low valuation. Not available for zero-rated exports, because they're saying, it's my client who's exporting. Well, it's your job to also get those documents, so very important there. Incorrect re-invoicing as well. Disbursements is something which a lot of businesses still struggle with. I have a cost that is charged to me, Is it my cost, or is it the cost that I'm incurring in the name and on behalf of someone else? Transitional provisions, I would really, really caution against. Saudi it was one of the focus points of Saudi in order to audit this. And sorry again, Ganesh, for drawing the parallel. I'll leave you enough time to discuss that. But UAE, Oman, Bahrain, all of them had transitional provisions, and these really need to be looked at. For example, in the UAE, a lot of businesses that had advanced invoiced in 2017, but for a service supplied in 2018, they forgot that there was an additional VAT to be paid. And of course, in terms of the awareness of the penalties, it's a bit better in Oman, I would say. But in the UAE, you make a mistake in good faith, your penalty will go up to 3.56 times the tax. And people really need to keep that in mind. It's the highest that I've ever seen anywhere. There's no prison sentence, luckily, like in some of the other GCC countries, but it is nonetheless very high. In terms of the implementation and action plan, I'll leave that for a bit, but I'm happy to hand back to Ganesh right now on KSA.
Thank you, Thomas. Thank you. I think from my experiences, all what I've seen is after the implementation, they those meetings on the accountant side, and also you handle VAT, and just give me the reports by the end of the month, and they don't really interact with. They don't do the hands-on training, hands-holding. So yeah, I totally agree with you. I think people think once VAT is implemented, that's it. Nothing is going to change. I don't need to revisit my process. I don't need to revisit what I'm doing each and every time new regulations are published. So yeah, I totally agree with you. Ganesh, would you like to give your input on what really happened in Saudi, how really behaving after being implemented?
Yes, definitely, Rami. Thanks, Thomas, once again. Hope I'm audible. I'll start. Actually, speaking... hello? Am I audible?
I can hear you.
Yes.
Yeah, sure. Thanks. So Oman actually has an advantage that VAT has already been implemented in other GCC countries like UAE, Bahrain, and Kingdom of Saudi Arabia. So they can definitely leverage on the lessons learned during implementation. So if you ask me what would be the first lesson, I would definitely say that read the other GCC countries' VAT laws and regulations. And of course, the guides, periodic guides, which they have released for each industry-specific guidelines, which Gazette or UAE Tax Authority or for Bahrain, they had released the industry-wise guides, so that can be read. And you know what? By reading, we can make it clear certain provisions like input tax, then how the capital goods treatment would work. Then what would be the requirements of a tax invoice? Because if you are charging a VAT, then there has to be it has to be through a tax invoice. And then the supporting documents like debit notes, if any adjustments needs to be made. So how the debit notes or credit notes, the requirements would be required from the system. And of course, this treatment of nominal supplies. If you are giving anything for free, so you need to understand the impact from VAT perspective. That would be the first thing from my side. And then the most important one is upgrades to ERP systems. This is like very important because manual, it would not be possible for each and every taxpayer to do it manually. So there has to be one proper tax system, ERP system with proper tax codes. And of course, user acceptance testing. So this is actually the time where the users needs to be acquainted with the system, how it works, how the VAT transaction would apply going forward, starting from April onwards. And then the business also can undertake a review of the contracts with their customers as well as the vendors. That whether any tax clause has been mentioned, because in this part of the world, the VAT is the first time it is getting introduced. So it is highly advisable to go through the contracts where VAT, whether any tax mentioned or not, and if at all mentioned, then what it is like, whether VAT is inclusive of the contract price or exclusive of the contract price. this needs to be taken care. And moving ahead, informing your customers and vendors that there is this VAT impact going to happen, there is this VAT introduction going to happen in future, and then you need to train your customers or vendors, because in most of the cases we have observed that because of non-awareness to the customers or the vendors, usually they don't apply for the VAT. And what happens, that once VAT is applied here, whatever the input tax credit they cannot claim because they are not registered. So they may try and jack up the prices, which actually would be a problematic situation for the business, because they cannot claim any input tax credit as the customer is not VAT registered, so he cannot raise a proper tax invoice. So this needs to be taken care. What we suggest here is you should send letters to your customers, your vendors, that VAT is going to happen sooner than later, so you need to take care of it. Then another lesson would be claiming of input tax credit, because we have seen in our 2-3 years journey that basis some letters or some quotation, business claims the VAT input tax credit. But for claiming the tax credit, there has to have a proper tax invoice with prescribed one, with all the mandatory requirements in the invoice. Otherwise, there will be penalties. And as Thomas rightly said, penalties in this part is huge. So, for example, if I can give you quickly. Okay. If you fail to get yourself registered, the penalty is US $2,600 approximate. And then once you get registered, you need to, as Deepika mentioned, you need to file monthly or quarterly VAT returns. So if you fail to file a return, then the penalty is 25% of the VAT payable. And the other thing is, okay, you filed the return, but you didn't pay the VAT on time. So there is a 5% of VAT due for each month. For example, in a year you didn't pay, then it would be 12 into 5, 60% we are talking about of the total VAT. So sometimes it may happen that the VAT amount is small, but the penalty amount is on the higher side. So this needs to be taken care, Rami. That's it from me.
Thank you, Ganesh. I think draconian measures sometimes when it comes to fines and
exactly.
And how they're imposed and how they're calculated, but it is what it is. So now looking at that VAT, I mean, we're 1 month away from VAT going live in Oman. So I think that the next question is to everyone, is what would be the action plan in the next 30 days? And I'd like to start with Deepika. What would be your action plan for the next 30 days if you're preparing for VAT? So. I think that you're on mute.
Sorry, I was on mute. Okay, from the perspective of VAT, I would say the most crucial point, as Ganeshan has said, was to review contracts. Let's understand what is a contract. It's basically an agreement between two parties, which is legally and commercially binding. So in order to amend contracts, as we understand, if we do not amend, it would have a financial impact for the business. So it is best to review the contracts, which could be short-term and long-term. As we can say, as Thomas has also said, that at times you would receive payment in advance for a long-term contracts, but the service was actually levied after the go-live date. That would actually have a VAT impact. But if your contracts are not amended, we should understand that the exposure of VAT would actually lie on the seller rather than a buyer. So we have to ensure that the contracts are first amended. We have to speak to our vendors, our customers, to ensure that our contracts are amended, and it should not be a cost to the company. Second thing I would look into is I implement the IT system, which is again a very crucial point, which I assume Hilal will take over. But we have to ensure that there should be a readiness with regards to IT system, because considering that there could be an element of VAT rate change by next year. So we cannot have a manual system where we say it's going to be 5%, and next year we have to ensure that it could be 10, 15, it could be anything. So we have to ensure those are incorporated. There could be a provision where certain items which are zero rated could become a standard rated in going forward. So it's very important to ensure that all the systems are actually incorporated within the IT system. Thirdly, I would say to get regular VAT alerts, I would say all the organizations have to be engaged with their tax advisor. As said earlier, there could be a lot of changes. Like there would be COVID-19 rules could be changed where the VAT filing could be delayed, which you could only come to know once you engage with your tax advisor. From the perspective of direct taxation, the new law has come where we have to actually file our annual returns within 4 months from the year end. So whoever year end is on 31st December have to file their direct taxation within 4 months. So this is a new law which has come from direct taxation. So if you're not engaged with your tax advisor, we might not be able to understand what are the changes which are going to be incorporated with the Ministry of Finance. Third, I would say it's recommended for the organization to identify VAT champions so that they understand what are the VAT complexities. And if there's any VAT change which needs to be done, has to be taken. You have to understand the registration date, because if you do not register before 15th of March for the first segment, as rightly said by Ganeshan, that there are a lot of penalties for non-registration on time. It's not as bad as Saudi and UAE, but definitely we have penalties for late registration. And we should ensure that proper trainings are provided to the employees, registration is done on time, VAT compliance like filing of returns monthly or quarterly are being done by the employees. This could only be done only if the employees are trained. From the perspective of finance manager, I would actually say that he should ensure that the cash flow budget is taken into consideration, because basically VAT is not an impact to a business. It's just a cash flow crunch within the organization. So finance manager should ensure that the cash flow is managed well during the VAT scenario. That's it. The action plan. Over to you, Thomas.
Thomas, if I just may add a question to you, because I've heard it before. Some people like to take the shortcut and say, just focus on your output tax. Just ensure you get your output tax right when it comes to preparation. Is that a good advice or not? I mean, please, can you incorporate, highlight,
Sure.
what's your
Essentially in the VAT return, you'll be reporting your own output VAT, and it's true that that's something which you control yourself. So you're more in control in order to make sure that that's correct. Your input VAT, it is true that to a certain extent you rely on what your vendors are sending you in terms of contracts and invoices, but those need to be compliant. And the beauty of the VAT system is always, it's the easiest system for a tax authority to implement, because businesses audit each other. So you as a business, you're required to audit the invoices which are being sent to you. And then you will tell that business, if you, depending on your contractual relations with that business, you'll say the invoice is wrong, we cannot accept it. Please amend it. Of course, and that's again one of the lessons also from UAE is when you're dealing with, let's say, a very, very large telecoms company which has one single invoicing format, and you can see when you receive the invoice it's completely wrong. I think I would, let's say, it's very discouraging to try and run after an actual compliant invoice. You might not get it. It might be better just to write off the 5%. So I think that's an important thing as well. Those are more of the practical elements in it. A few points that I wanted to mention is the implementation of VAT is not a one-size-fits-all, and that makes it very difficult. We have some clients who have 3 people, but they have turnover of a few $1 billion because they trade in oil. And we have other clients who have 50 staff and their turnover is much, much smaller. It requires a different approach. And this is really something where businesses need to reach out to, I would encourage a number of advisors to try and listen to them and try and see if they can determine together what is needed for the company. I would say really do not underestimate it. And a recommendation that I would make is if you're a mid-sized company or a big company, you need to hire a specific tax resource. You need to hire that person. Do not solely rely on internal hires. In addition to that, what I see very much as a frustration of some of the tax hires who come from other regions and they come here, it's not a mature tax market, and that also means internally, I meet head of taxes who feel very lonely. It might be a bit weird, but they don't have the buy-in internally of the finance team, of the legal team, of the logistics team. Those teams, they have operated by themselves, and they do not see the added value, that's with a little wink, of having a tax resource in there. And the added value is really to avoid penalties later on, to optimize things. And I think that dialogue is operationally probably one of the most complicated things to engage in when you start as a tax advisor in a company. In terms of where the tax function sits, and I think this is important as well, for me at least, my personal opinion is the tax function is not finance and is not legal. It's somewhere in between. And you may have a smart accountant who says, I'm doing all of the accounting and then I'm going to take tax in addition to that. It's usually not a good idea. If the company is mid-sized to big, it requires a different mindset to do tax than to do accounting. And I wrote down a few examples of this. For example, what we see sometimes, which is wrong, is a supplier tells a client, I'll give you a discount. The client says, okay, fine, I'll send you an invoice for the discount. So from an accounting point of view, those two, they come down to the same thing, because revenue will be recorded on the one hand, and on the other hand, you record a discount. From a VAT point of view, it's completely wrong, because the supplier needs to issue the credit note, and you cannot have a client issuing you a debit note. Another thing, for example, that we've seen is goods being resold, and instead at the same value, and instead of selling it at a higher value, the supplier sends an invoice for a commission for that. It's again, commission is a service, whereas it relates to the supply of a good. So you're essentially making two mistakes, which is one, you're issuing an invoice with VAT for which VAT is due. And on the other hand, you have an insufficiently high invoice for the supply of the goods that you make. Those are two examples where if you approach it too much from an accounting point of view, you'll get in issues from a VAT point of view. And a third and final example is time of supply rules. The legislation has specific time of supply rules, which determine when to report VAT. Those do not tie back to how you record invoices in your accounting system. So it's possible, for example, that you issue an invoice on, let's say, the 5th of May, 2021, but which relates to a supply made in April, which means the supply needs to be reported in April. And those are just a few examples where you see really, if you've got too much of an accounting mind, then you'll go wrong. Equally so, if you've got too much of a legal mind, you will not understand all of the accounting ins and outs. I would say, as a final recommendation, big businesses, they need a project manager, really, to roll out a plan. The mid-sized businesses, they need to try and identify what their needs are. For sure, what you need, always guaranteed, is technology for this, whether it is for issuing invoices or for VAT reporting. It's simply impossible to do this without. It will help you minimize your mistakes. It's simply indispensable. Back to you, Rami.
Thomas, thank you, Thomas. Ganesh, would you give some advice as well on an actual plan look like it's fitting for the next 30 days?
Yeah, definitely, Rami. So I must say here, I appreciate the audience's poll also, because they have said 54.5% of the audience said they don't engage with the tax advisors. So honestly, I would suggest here is that identify a well-experienced VAT project resource, and also invest in technology, because the need of the hour is the extensive use of technology for the entire process. for the entire process from preparation to implementation and introduction of VAT. Which is giving an opportunity actually to upgrade the accounting systems and its processes as well. That if you invest in technology, the advantages would be multifold, starting from prescribed generation of tax invoices, claiming correct input tax credits, reverse charge transactions would be mapped, and then accurate VAT return filings can be possible, which will also help during the VAT audits and assessments by the authority. Let me say here that VAT is going to stay here. It's not that it is coming and it would vanish one day. No, and most importantly, the record keeping would be like for 5 years or 10 years, or in the capital goods or in real estate cases, it's like, I mean, I'm talking about KSA perspective, it's like 15 years. So which means in 2021, in 2035, they may go for an audit of 2021. So that is the audit period they have kept open. That's the length of the audit period. So whatever you are filing the returns, try and ensure that it is accurate, because after, during the VAT audits and all, there may be a problem that this may get penalized because of some wrong mapping of transactions. And also here I would like to update is that KSA is moving ahead with its implementation of a concept called electronic invoicing from this year and onwards, like to be specific, from 4th December 2021. So therefore, in all likelihood, Rami, e-invoicing shall be replicated in other GCC jurisdictions as well in the due course. So I would say here is that this is the right time to invest in systems and automate the processes which shall ensure that business are VAT compliant, thus avoiding the heavy penalties which Thomas mentioned for UAE and myself mentioned for the KSA. So the action plan is like, if not started, start. I mean, because each minute is like very crucial. So start by today, if I can say so.
Absolutely, I'll totally second that. If you haven't started, I think it's a bit alarming, but you need to start as quick as possible, in my view. So, Hilal, would you like to give some inputs on what would an action plan look like for the next 30 days?
Yeah, sure, of course. Hope you can all hear me clearly. So yeah, as Deepika mentioned, that we can't continue doing this stuff manually. Because as you know, Rami, Thomas, and Ganesh, and I think you all agree with me about this point, that in the GCC region, the IT system landscape is quite different than elsewhere in the world, as we have a lot of legacy systems and in-house build system that are still in place and running as of today. But using these legacy systems is quite difficult to build and code the VAT logic into it. So in my view, the action plan that they start to do the impact assessment, which Thomas and Ganesh, Deepika mentioned before. And part of that impact assessment, which has to be performed by a tax advisor, businesses in Oman should start checking their IT landscape in terms of where they are now and where they need to be by the 16th of April 2021, and make sure they are ready with the basic requirements of the VAT. So when it comes to the VAT reporting process, which is the preparing for filing the VAT return, there are a few options out there businesses in Oman can go with. The first one, I would say that they can do it by you can do it by yourself using Excel and trying to prepare to file your return using your raw data from your source system, and play with Excel and get your return. The second one, that you can implement a VAT reporting tool. That will help you to streamline your process and create your VAT return within that tool and then file it to the government portal. And the last one is that you can outsource it. Give it to your tax advisor and take the problem off your hands. But you need to consider the cost of these different option is different. This option is different. And you need to understand and make sure what is the best option for your business. So in conclusion, what I'm trying to say here that having your tax advisor, your system integrated, is very crucial to be ready for VAT. and to make sure that you can get the right level of data out of your system in order to be VAT compliant. Back to you, Rami.
Thank you, Lal. Thank you. Very insightful. So now moving on to the last section of the webinar, which is what would be your technology strategy. While I shed some light on that, there would be a couple of poll questions showing up on your screen. Again, I'd encourage you to give in your answers to make it more interactive. I mean, I'd like to quote Thomas that there's no one solution, one size that fits all when it comes to technology. You need to really assess what would be the most appropriate technology for your size of business and for your line of business. Some businesses, if I would say to Thomas's point, again, I might be an oil trader, so I have a few transactions on a yearly basis, but the value of that is too high compared to, for example, a retailer who owns a chain of supermarkets. So every business, there's no solution that would fit all. My advice from a technology standpoint, I would totally, so when you go to a VAT automation project, one of the biggest mistakes that I've seen that actually it's considered as an IT project. And sometimes also it's considered as a finance project. No, they both should go hand in hand to ensure that you have the right tax coding in place and ensuring actually you need to assess whether your current system is fitting to do the job or you'd actually need to look at other solutions out there in the market. When it comes to tax technology, there are a few options on the market. You can look at concepts that are called tax engines. These tax engines, they come in the picture, they automate the tax calculations and they automate the tax coding. But at the same time, a small business might not look at a tax engine because it's not really what they need, and they need to really focus on their current systems. And to Hilal's point, some systems really are not built to incorporate tax logics within them. So again, and I'd like to summarize all of what I've said. There's no one size that fits all. This will never happen. This is not the right approach to look at it. You need to really assess what is the right technology for you as a business and in comparison to your size and what line of business you operate within, and that will help you assess to choose the right solution for your business. And the main advice that I'd really like to stress on is really when you go through a VAT automation project, finance and IT need to be talking to each other rather than looking at it that it's an IT project. When I've worked with some clients actually after go live where their initial preparation was completely done by IT. I'm actually going to give a very naive example, but this is really what I've experienced. Some people is like, what's the difference between exempt and zero rated? Both are zero anyways. No, but from a tax perspective, they do have a big impact on the way you operate your VAT return. But an IT person might not really get what's the difference between exempt and zero rated, because at the end of the day, he sees both of them as zero. But when it comes to tax coding and VAT return preparation, it is really, really important to stress to ensure that the project is done by IT teams and finance talking to each other to ensure the best results for you. And first of all, to choose the right technology. I'd open up the floor now if Thomas or Ganesh or Dipka would like to add here. I mean, I'd start with Thomas. Any advice on the technology strategy if I would ask?
Sure, Rami, thank you. I'm going to sound like a broken record a bit, but yeah, it's back to what you were echoing. There's no one size fits all. I think even if you're companies with a little amount of transactions, they need technology. You need software. It's simply necessary. The businesses which have a very high volume of transactions as well, it's necessary just for reconciliation in order to pick up errors. It needs to be something that ties well into your ERP system. And unfortunately, we're a bit in a situation where, a month and a half away from the introduction of VAT in Oman, it's going to be difficult to find those resources. And let's say when UAE and KSA introduced that end of 2017, beginning of 2018, there was a massive frenzy in the UAE to get resources and stuff. I feel like that's insufficiently going forward right now in Oman. It's I'd say it's maybe a symbol of a not so mature market still, but I think it's simply from it'll almost be, it's a very high responsibility, very important responsibility for the finance people to look into it and identify it and get it right from the beginning. We all know when you want to change software, when you want to change accounting system, how much work it will require when you want to change. So it's very important to get it right from the beginning.
Thank you, Thomas. Thank you. Devka, would you like to add some inputs from your side? I think you're on mute, Devka.
Okay. From my perspective, I would say it's best to engage an IT provider right now. Since the regulations are not out, like as Thomas said, in Bahrain, it was just issued 12 days before the VAT went live. All the IT providers will be able to implement VAT inputs and outputs only once the regulation is out. So if you do not engage your IT provider now, you will not have enough time to do your, you will not be able to input the same into your current system. So let's say if the regulation would be out 3 weeks from now, and we have n number of companies in Oman. So if everybody is having tally, knowing that 80% of the market in Oman is having tally, and the IT provider would have to go to each of the companies in order to incorporate VAT changes in their system only once the regulation is out. So first, I would definitely say that every organization needs to ensure that they engage their IT provider and it's not done at the last moment. Second, once the regulations are out, definitely the invoicing structure should be taken into place. It should be proper. As Thomas said, if we do not have a proper invoicing from a vendor, it could be a cost to the company. So it's important that the vendor is educated, that his IT system is taken, he provides proper invoicing. And similarly, once an output VAT has been charged, means once an output VAT is charged, a proper invoicing is done from their end. So that's it from my side.
Thank you. I think given the time, we have 3 more minutes, and I'd like to open the Q&A. If there are any questions from the audience, happy to take them. And let's see, a couple of questions unanswered. I think there's a question about companies in the free zones. Does VAT apply on them? So, I mean, would Thomas, would you like to take that question? I think it's not clear yet. I think it's related to executive regulations, but would you like to pick that up?
Sure. So there's a few hints in the law already, which say that the operations or transactions in the free zones or special economic zones will be treated as if it's under customs suspension. So I think that's the first hint. I think that we can expect it to work broadly like in the UAE, but it remains a bit to be seen. An important difference already that we've seen as compared to the UAE is in the UAE you can group free zone companies with non-free zone companies, and in Oman that possibility is not there. I don't know if Deepika wants to add something to that as well. Important topic, always recurring. Deepika?
I'm sorry, Thomas. Sorry, I missed you, Thomas. What was it?
No, I was just throwing the ball back at you to see if you wanted to say something else about free zones and special economic zones.
Again, the regulations are not out from the perspective of VAT for free zones. So we just have to wait for the regulations out on that. So I have nothing to say from Oman perspective.
I think yeah, sorry, I think I'm on. Yeah, so Yeah, most of the remaining questions, most of the questions on the Q&A have been answered. And most of the remaining questions were around the same topic, free zones. So thank you, Thomas, for shedding some light on that, and Deepika as well. So that brings us to the end of this webinar. I'd like to thank you all for submitting your questions. As mentioned, we will respond to any unanswered questions via email. The recording will be made available on the same link, and an email will be sent as well. Thank you to our speakers for taking the time to speak and for sharing their insights with us. That's it for today. Thanks again, everyone, and have a lovely day.
Thank you.
Thank you.
Thank you, Rami. Thank you.
Thank you, everyone.
Thank you.
Thank you. Bye-bye.
Thanks. Bye.